Good morning, this is Ken Long from Tortoise Capital with the review of the weekend trading reports for April 24th, 2016. Market is in bullish quiet conditions. That's very favorable for the long side. On an annual basis using weekly RSI 14, we're improved to 60, so at the higher end of neutral. 70 is the threshold for overbought on that indicator. On a 10-day basis using the 10-day NDX, we're at 73 out of 100, so again the higher end of neutral. The threshold for overbought is 80 on that indicator. In the market mosaic, price with respect to the 200-day moving average is 4.63%, so green bullish. Slope of the 50 improved to 1.25, also green bullish. ADX strengthened to 18.9. It's neutral but strengthening and favoring the bulls. The risk index is the 30-period moving average of the VIX divided by the 10. The threshold between risk on and risk off is 1.0. The current reading is 1.05, so we are into risk on. Take that number and compare it to the last 5,000 trading days, and we are able to compute the risk Z, and that reads at 0.57, meaning we're 0.57 standard deviations above the long-term average. This is a 90-day histogram of that indicator. You can see we had a sharp increase in volatility, which then improved, held at a higher low, improved up to plus 2.3 SD. It decayed, but held above the zero line. That's really favorable, and we're starting to get quiet again. This is a very favorable condition, especially when you combine it with bull quiet and favorable slopes and some of these other indicators. These are the current holdings in blended monthly rebalancing. The next reevaluation due on or about 1 May. And these are the current leaders based on prices at the close of Friday for these various portfolios. This XME and Caterpillar and 3M and DuPont and Chevron reflects the strength that's been flowing into basic materials. You also see coal and some energy plays down here as well. Theoretical exposure in ETF2 is 100%. The model portfolio is at 100%. We added a second position to XLP to get us to that point this week. These are the current holdings in ETF 13 and 32 and their current readings. Everything now is on a buy signal. Everything's better than its 4-month moving average. Strength in the Latin America and Australia for the commodities, Asia less Japan, emerging markets. And then in the ETF 32, which takes that basic set and expands it a little bit more, Brazil, emerging Europe, the BRIC countries, energy, materials. In ETF Max, gold and precious metals remain at the top, along with materials all over the place. Canada, lots of Brazil in every dimension, Russia. So it's really that kind of the economic move on that end of the business cycle. In the S&P 500, some things that we're going to look at for follow-on performance: Freeport Moran, Murphy Oil, Chesapeake Energy, Audio, Marathon Oil, Southwestern Energy. So you can see that there's some momentum plays there in energy that's either going to continue or have a sharp reversal, and so that extra momentum is going to really favor us in our style in the short term. Some leaders that had some big pullbacks, we might be looking at a rebound on something that was strong or a continued weakness, so we'll be looking at Mattel and Tyson Foods. The market health check, you can see that vertical blue lines are 10, 20, and 30 days worth of look back. Swing high, that's been our price target ever since this rebound occurred, is up here around 211. It's finally just about approaching it. Had a couple dojis and a test. I like the fact that it held over the weekend. This is a natural place for the market to find support at the edge of the dragon, at the edge of the river. The 10-period regression line and channel is up. The 30 period is up. The slope of the 30 regression line has come from all the way to the bottom, peaked over here at about 0.7, has rolled back, and now is stabilizing here around 0.3. That's actually healthy for the long term, because in this 20-day period where it could have failed back to the Bollinger Band mean and below the 200, instead it held, and then the pause that refreshes, and now a resumption of that upward move, tentatively approaching this all-time high. So if we can get above 211 and hold, then there's an argument that another leg of the size of this leg is potential is in play. So on the downside, I see support at the Bollinger Band mean. Well, really at the bottom of the dragon. If that doesn't hold, then Bollinger Band mean, and then it's the far side of the river at 202. 202 to me is the real key, because that preserves the bullish move and continues the narrative that this is the next leg starting. All of the regions in the ETF2 model on a buy signal, which leaves us at 100%. The indexes are so low because the materials and energy sector have been so high, and that drives all those to the top. They're pulling away so much that it really makes the indexes lag in comparison. The S&P at 30 is better than the globals at 19. The S&P is the strongest, followed by the small caps, who are starting to make their little rebound perhaps, then tech, then mid caps. Inside the S&P spiders, it's materials have really just leaped to the top, as you can see, and seeing a little rebound now in financials, and the previous winners, staples and utilities, are starting to back off a little. So it could be a changing of the guard. Mixed bag inside the world market model for the U.S. Strength in the Dow and the S&P. Corporate bonds took a hit, and maybe this is a recycling towards equities. Mixed bag in Asia, less Japan, but still doing better than Europe. Canada and Brazil doing very well. Materials across the board, very strong. Seeing the same kinds of trends coming out of ETF2 lens. Materials making a really nice run here. Strength in natural gas, South Africa, India, and Russia. And then Canada in the green and white is an interesting play. And Goldman Sachs, which had been getting smashed, is now green and white, making a little recovery in the financial sector. Among the Dow symbols, Home Depot, Chevron, Nike at the top, joined by DuPont. The three weakest being Pfizer, Walmart, and Merck. Volatility stats shifting to the daily. Lots of channeling and overreactions to choose from. Plenty in the auto framer to work with as well. Half a dozen in the Dow 30 that test out better than 2 to 1 on the auto framer. Lots of good frog candidates are starting to develop, and these in the that have fired on RSI2, these are things that have had a 2-day washout, and so Microsoft and Apple become interesting plays. They had like a 2-day sell-off, and then testing out really well with the auto framer and on the reward to risk basis. So I'll be framing those later tonight for the online day trading workshop. A 5DD here in treasuries, a handful of channeling and overreactions, just a couple fraud quality numbers. These were strength leaders before. Treasuries, utilities, and staples have pulled back. They have nice reward to risk ratios, but I would need to see weakness in the S&P coupled with their performance before I would just jump on board them, because I think there's a potential that we have a turning point in the leadership in the market now, away from the defensive plays and more towards the growth and basic materials sector. Here's the stats on the auto framer and the regression line fractal framework. You can see the deep value plays: Nike, Microsoft, Travelers, Coke, and Intel. If you look at the daily debriefing that was posted in the chat room from Friday, you see some 4-hour trades in Intel and Coke lending themselves very nicely to intraday trending, and that's why I think there may be some more there, because there's some there's some definite interest in the symbols that's driving the trade. Much more trending and volatile intraday than the broader indexes. So those are a couple to keep an eye on. The ones that are most above their RL270, these are the strength leaders: 3M, Caterpillar, Walmart, Chevron, United Tech. The daily squeezes are ones that have large ranges on average, but were compressed on Friday, so a one-day pop is really possible. I'll be looking closely at Goldman and Bank of America here. Market mosaic. The polynomial regression line has started to expand and pull away, so that's why I'm thinking there's a potential for a nice rebound off this slight pullback. The RL10, or the slip of 30, has crossed its own moving average 10 here and finding stability. So that suggests maybe the scenario is not this big sell-off, that this is a potential for another leg up. So I'll be watching this as a turning point and maybe a confirmation of the return of the bull now that we've dug out of this deep hole. We'll see how it goes. We're back inside the plus and minus 1 range for normal regression line slopes without really giving too much back after that little peak and that nice run up. So that's favorable. Volatility remains low. So while I'm sensitive to how quickly that can change, and I'll be ready to exploit it with VXX, this is more evidence to me of a potential support for a longer term move. So just throwing some stats on there for you to stop if you want to look at it. The fail stat, the gain stat, gap stat, signal to noise ratio. You'll notice that XIV is among the leaders. A very strong signal to noise ratio simply means that we have a exceptional intraday trendiness, that most of the day's move is trending as opposed to being found in the tails of the candlestick. Conversely, the things that are really choppy are things like down here in the red. So when you have nice gains intraday with these, you want to lock those in before they inevitably reverse. Z-scores of the regression line slopes. The 90 has turned very positive, is right at the boundary of normal. So this 90-day move is really strong now. And so we're almost at the point where we can say we may have cleared the support here. We got to really get above 211 and keep going. So if the herd came back to the river and took a drink and now is ready for this next leg, we can say this is leg 1, and then maybe we have another leg 2 that would take us up vicinity 220. So we got to get above 211. If we were to get above 215, then it's really free and clear and smooth sailing. To me, that's still lower probability than a pullback to the river, but my bias is towards political instability and uncertainty, making this more channel bound until a true leader begins to emerge. And that's everything I want to cover for this week. I would just say that since I know what my bias is, I'm still structuring my trade so that if I'm proven wrong, it doesn't hurt me, and I let price actually do the driving. I'm just prepared to go in either direction because I see us being at a critical state here, and that's where I think we are. So, it's Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.